Hi friends, welcome to my channel. In this lecture, I would discuss accounting equation and debit credit rules. Accounting equation. This is accounting equation which says that assets of the business are always equal to the liabilities of the business, including capital provided by the owner. This is actually the formal expression of dual aspect concept which we have discussed earlier. Here it is for the review. Dual aspect concept says that every business transaction has two equal effects on business accounts, and these both effects must be recorded in the accounts, because if only one effect is recorded, then accounting equation would not equal, and as a result whole financial position of the business would become false. These both of effects must have some money value which would equalize the both sides of the accounting equation, or debit or credit sides. So now we would discuss what is assets. Assets is any source which is kept by the business and is expected to earn profit for the business in future. For example, cash of the business, bank account of the business, debtors or account receivables, goods or purchases for resale, stationery or any other office equipment, office building, furniture, machinery, goodwill, etc. These all are the assets. So what is liability? Liability is any amount which is payable by the business to someone. For example, creditors or account payables from which the business has purchased goods. So business would pay them in the future, and it is the liability of the business. And notes payable, promissory notes, it is also liability of the business to be paid in future. Capital and owner's equity. It is the fund provided by the owner to business, either at the time when business was launched or when business is running. It is also a liability of the business to the owner, but it is treated or recorded separately from other liabilities, as we have seen previously in the accounting equation, that liabilities plus capital. Liabilities are other liabilities and capital is the owner's equity. Drawings is basically when the owner withdraw goods or funds from the business for his personal use. It is basically decrease in capital by the owner. So as we have seen, in business transactions there are always two or more effects. So when a business sells something to the customer, it has two effects. That business is giving a product or service to the customer, and in return the customer is paying cash to the business, or else he is promising to pay in the future, which is debtors, which would be account receivables. So the two effects which are in this equation would be sales, as sales is increasing, and cash or debtors. So here it is accounting equation in detail. For example, assets equals liabilities and capital. So if a business has assets 1000 cash, 1500 in debtors, 2000 in machinery, and 500 in office equipment, it is the whole assets which is equals to 5000. Okay, and in liabilities the business has 2000 in creditors and 1000 in notes payables, and owner's equity is of 2000. It is also 5000 in total. So both the sides are equal. So let's assume that it is the beginning of the business. So later the business purchased 500 rupees worth office equipment. So the office equipment would be increased by 500 and cash would be decreased by 500. And then business paid to the debtors rupees 1000. So debtors would be reduced by 1000 and cash would be increased by 1000. It is the amount received from the debtors. Debtors decreased by 1000 and cash increased by 1000. Now business paid to the creditors 1000. It would reduce creditors by 1000 and reduce the cash by 1000, as we are paying cash to the creditors. So both of the sides have negative effect. So and now if business accepts notes payable and receives 2000 cash, so it would increase our cash by 2000 and increase our liability, which is notes payable, by 2000. On the both sides it would increase 2000. Now if the owners induced some more capital of worth 1500 in the business, so it would increase the capital by 1500 and 1500 in cash would be increased. So both of the sides of equation would be increased by 1500. Now if the business purchased some machinery but on credit, it would increase machinery by 1000 and increase the credit or our liability by 1000. Now if the business owner withdraw 500 from the business, it would reduce capital by 500 as well as cash by 500. So both of the sides of equation would become equal. Now as we total the both of the sides, assets, cash would become 3500, debtors 500, machinery 3000, office equipment 1000. It is total 8000. And liability sides, it is becoming 2000 to creditors and 3000 to notes payables, and owner equity is 3000. So 5000 plus 3000, it is also 8000. So as we have discussed earlier, that both of the sides of accounting equation must be equal after every transaction. So we have seen here that after a number of activities, the both of the sides are still equal. So now we are discussing debit and credit. What is meant by debit? Basically it is increase in assets or expenses or drawings. Assets, as you know, assets includes cash, bank or debtors, etc. Expenses could be utility bills paid by the business, office rent paid by the business, or etc. And drawings, which is decrease in capital, as we have discussed earlier. So increase in these three things would result to debit. And now if there is a decrease in liabilities of the business, capital of the business, or sales or revenue of the business, it is also debit. Liabilities includes creditors, notes payable, etc., and capital, which is owner's equity, and sales or revenue, which is the income of the business. So decrease in these three things would also be called debit. Increase in assets, expenses and drawings, or decrease in liabilities, capital or sales is a debit. Now what is credit? Credit is basically increase in liabilities. It is vice versa. Increase in liabilities, capital and sales, or decrease in assets, expenses and drawings. Credit and debit both are opposite of each other. So if you remember, in debit there is increase in assets, expenses and drawings, while there is decrease in liabilities, capital and sales. Now it is opposite in credit. It is increase in liabilities, capital or sales, and decrease in assets, expenses or drawings. Now In upcoming lectures, we would discuss journal entries in detail, which is the basis of the accounting records, and practical examples of debit and credit rules we would discuss in detail. Thank you.